When the crypto market crashed after the October 10th liquidations, everyone was desperate for a glimmer of hope. So when an institutional report claimed that the crash had actually reset the board for crypto to reach higher highs, it quickly went viral. Suddenly, FUD was replaced with FOMO, and traders started looking for dips instead of doom scrolling on X. That's why today, we're breaking down this report in simple terms, explaining why things might not be as bad as they seem, and what could be next for the crypto market. My name's Lewis, and you're watching the Coin Bureau. Before we get started, you need to know that I'm not a financial advisor, and nothing in this video is financial or investment advice. It's educational content that summarizes a recent crypto report. That sounds good? Well, prove it by punching that like button, and let's get into it. Now, the report we'll be summarizing today is the monthly outlook report from Coinbase Institutional, and is titled, quote, Market Recalibration, which should give you a sense of what this report is all about. As always, we'll only be summarizing the key highlights right here for you in this video, but we'll leave a link to the full report down in the description below. The report kicks off by suggesting that last month's massive liquidation event marked the local bottom for the crypto market, and could have actually set the stage for a major move higher. In case you somehow missed it, October 10th saw a record $20 billion in crypto liquidations, as overleveraged long and short positions got wiped out after President Trump announced 100% import tariffs on Chinese goods. This created lots of uncertainty, and if there's anything crypto doesn't like, it's uncertainty. BTC's price dropped 10% from 121K to 109K. Meanwhile, crypto's total market cap dropped 20% from $4 trillion to $3.2 trillion. To put things into perspective, the October 10th liquidations were 9 times bigger than the flash crash we experienced back in February this year, and 19 times bigger than when FTX collapsed in November of 2022. To help further put things into perspective, the report compares the October liquidations to the so-called Great Grain Robbery of 1973. Contrary to the name, the Great Grain Robbery wasn't actually a robbery at all. Instead, it was a coordinated effort by the Soviet Union to quietly buy up as many global wheat and corn stocks as possible within a single month. This drove food prices up 30 to 50%. Before anyone even realized that the Soviet Union was actually facing massive crop failures, ultimately leading to the creation of satellite crop monitoring systems. But what does this have to do with crypto? Well, according to the authors, October's liquidation event bears a striking resemblance. That's because just like with the Great Grain Robbery, the crypto market suffered from lack of quality information around times of thin market liquidity. As soon as Trump made the tariff announcement, investors panicked from the uncertainty that would inevitably hit the market and hit the big red sell button. This caused crypto prices to fall past the liquidation prices of many traders, sending prices even lower. Less liquid altcoins took a beating, with many falling anywhere between 40 to 70%, with some falling even more. The reason why altcoins were so badly effective is because altcoin liquidity is fragmented, being split up across multiple exchanges and on decentralized exchanges that automatically liquidate positions when the market works against leveraged traders. Each liquidation triggers a domino effect, where falling prices cause even more positions to be liquidated, driving prices lower, and so on. The next part of the report is where things get interesting, and it's where the authors give us a shot of hopium. In their words, quote, our view of the sell-off is that this leverage flush was a necessary reset for crypto markets rather than a cycle top, potentially setting the stage for a grind higher in the months to come. Whew. If that has you feeling all warm and fuzzy inside, then you're probably going to want to buy some crypto. The best way to do that is a Coin Bureau deals page. That's where you'll find exchange bonuses of up to $100,000, trading fee discounts of up to 50%, and deposit cashbacks of up to 75% on the best crypto exchanges. Just hit the link in the description or scan this QR code, which will take you right to the deals page. There, you'll see all of our offers across a range of exchange partners. Simply click one of the sign up now buttons and that should take you right to the deal. Remember though, these deals won't be around forever, so take advantage of them while you still can using the link in the description below or by scanning the QR code on the screen. Now, back to the report, where the authors explain that prior to October's Black Swan event, their biggest concern was that the crypto bull market was ending. That's because a Coinbase survey prior to the liquidations found that 45% of institutional investors believed the crypto bull market was in its final stretch. Come to think of it, this alone might have worsened the crash. After all, anyone following the so-called smart money would have likewise assumed the crypto market was running out of steam. So when prices began to fall, they likely panic sold, adding even more fuel to the fire. Speculation aside though, the authors point out that in the wake of the October liquidations, the crypto market now has more freedom to move higher. The catch, though, is that they expect any upside to come from market structure repair, rather than from any major headline catalyst. Say, isn't the US currently working on a market structure bill as we speak? Anyhow, the report notes that leverage across the crypto market has largely reset, based on a ratio of total derivatives open interest to the crypto market cap, excluding stablecoins. Intriguingly, the authors say that this is a key metric to watch in the coming months, adding that current levels point to brief liquidity gaps and shorter price tails until market depth recovers. Put simply, this means that we can expect brief but sharp liquidity changes that cause quick price swings, but fewer extreme market moves, at least until trading volumes and order books recover to healthier levels. So, a steadier market overall, but with sudden bursts of volatility. The authors then note that the future strength of the crypto market will be driven primarily by institutional inflows, who have protected themselves by keeping their leverage exposure low, and their allocations mainly focused on large-cap cryptos. These big players are expected to help the crypto market rebound, although it could be months before that happens. Notably, the authors predict Bitcoin dominance will gradually rise over the next 2 to 3 months, pressuring altcoins before an eventual rotation. And based on how traders are pricing their Bitcoin options, the data suggests that BTC will range between 90K and 160K, with upside potential being more likely. From our perspective, if leverage helps push the crypto market upwards as quickly as it pushed it down, then we could probably expect BTC to go even higher than many are expecting, as investors FOMO in for one final wave. Okay, so the next part of the report examines capital flows, which the authors describe as, quote, the cleanest read on market players' conviction after a downturn. By tracking capital redeployments from smart money, that is, investment funds, market makers, VCs, and top traders, we could get a good sense of where big investors are positioning themselves. This is important because it can often signal which areas of the crypto market are about to take off in the short term. However, there is an important caveat. And that's because even if a certain narrative is seeing huge waves of capital, this doesn't necessarily mean a pump is coming. This capital could be going to yield farming, liquidity provision, arbitrage, or even airdrop positioning. The authors note that it's not always clear what's driving these flows, and suggests using smart money movements to spot selective opportunities. Basically, watching which narratives are attracting capital and focusing on the projects within them that can pump. The report highlights that since the October liquidations, lots of capital has flown out of the BNB and Solana ecosystem into Ethereum's ecosystem and its layer 2s. Arbitrum and Ethereum itself are the outliers here, with Arbitrum having seen huge capital inflows. Intriguingly though, the chart provided in the report suggests that the Base and Optimism blockchains haven't gained any real capital flows, at least not yet. As such, the authors note that, quote, it might be prudent to keep an eye out for tokens on Base chain for potential inflection trades. Not a bad shout. Although it is worth noting that this report was written by Coinbase, which you'll know owns the Base blockchain. So it's probably no coincidence that this particular paragraph of the report contains more hyperlinks and details about speculative Base projects than anywhere else in the report. Just saying. Next though, the report explores smart money flows into different narratives. And since the crypto October crash, 2 clear winners have emerged. The first is yield protocols, as big investors reopen double-digit point-boosted APYs. But of all the yield opportunities out there, staking and restaking protocols are leading the pack, attracting the most capital and growing the fastest. A big reason for this is Grayscale's launch of staked spot Ethereum and Solana ETFs last month. And with more staked ETF applications on the way, this trend is showing no signs of slowing down. What might surprise you is that the other big winner is the utility narrative, specifically NFTs, the metaverse, and crypto gaming. These sectors have seen huge smart money flows, with momentum outpacing almost every other narrative. So if you're wondering which narrative could rally next, this might give you a clue. Not financial advice, of course. This ties into the next part of the report, which states that, quote, stablecoin flows also suggest we're seeing capital rotation rather than a wall of new money. Put simply, this means that the money sloshing around in the crypto market was already there. It's just rotating from one narrative to another. This is significant because without that wall of new money flooding into the market, we can't expect altcoins across the board to rally like they have in previous cycles. Translation is that altcoin season is now a dead concept, and hodling as a strategy doesn't work as it once did. The aim of the game now is to find which narrative will be the next to capture investor attention, at least until we see new inflows. If you're wondering which narratives to watch, the report highlights tokenized real-world assets, or RWAs, which have seen significant capital inflows. Last month, BlackRock's BULLISH fund deployed $1.5 billion, split evenly between Polygon, Avalanche, and Aptos, which attracted TradeFi investors to tokenized treasuries that offer stable yields of 4 to 6%. Notably, BULLISH leveraged the strengths of each blockchain, Polygon for its scalability benefits, Avalanche for its high transaction throughput subnets, and Aptos for its move language capabilities. And as the authors explained, the fact that BlackRock committed to expanding BULLISH despite the market chaos underscores the RWA sector as one with serious growth potential. Okay, the final part of this report zooms out of the crypto market and looks at the bigger picture. As the authors explain, quote, "It's important not to forget that crypto is still trading within a highly complex and increasingly risky macro environment." Wise words indeed. The report notes that last month's sell-off wiped away much of the excess liquidity that's seen in the later stage of the crypto bull market, which, as we've already discussed, is a good thing. That said, there are a few macro factors that we need to keep in mind. Everything from geopolitical tensions, global fiscal deficits, the valuations of other asset classes, and of course, tariffs. For starters, the report notes that even though the Fed is cutting rates, 10-year bond yields aren't falling much, staying roughly around 4%. And since long-term yields have barely budged, investors have become complacent about slowly rising yields. However, the authors warn that riskier assets like crypto and some equities could take a hit if yields spike. That said, if long-term rates rise due to real economic strength rather than policy concerns, that's a sign of stronger fundamentals. A growing, more efficient economy means companies can still earn more, even with higher rates, which can offset the negatives and ultimately support risk assets. Interestingly, the authors believe that right now, economists everywhere are underestimating productivity levels, partly because of the way that AI has dramatically increased the efficiency of many businesses, something that isn't captured in official statistics. And if you want to learn more about how AI is impacting jobs, well, be sure to check out that video right over here. In any case, this means interest rates may not affect crypto as much as analysts think. Instead, crypto prices will mainly be driven by crypto-specific macro factors, like market liquidity, investor positioning, the strength of the technology and adoption, and any good news from regulators. The authors concluded by reiterating that the recent liquidity flush has set the stage for crypto to grind higher, with bullish macro tailwinds like the Fed's rate cuts and regulatory moves such as the Genius and Clarity Acts. They predict that even though sentiment is pretty bleak right now, the crypto bull market could likely extend into Q1 2026. And with that, we've reached the end of this report. Remember, you could find the whole thing in the description below. For now, though, there's just one question that everyone wants to know. What does all of this mean for the crypto market? Well, in short, the brutal price action in the last few weeks could set the stage for bigger gains. From a technical perspective, crypto appears to have bottomed. As I record this, RSI levels on Bitcoin and most altcoins are at levels not seen since the spring. And as you can hopefully see, every time the RSI has hit these levels, this has marked the start of a major swing to the upside. This means that BTC and other cryptos like ETH, SOL, XRP, BNB could have bottomed and are close to another rally. And if the Coinbase report is anything to go by, it may be worth paying attention to the Ethereum ecosystem, particularly the layer 2s that have yet to see significant smart money inflows like Base, Optimism, and a handful of others. It's also worth noting that Bitcoin dominance has fallen dramatically since June, but has been slowly recovering since August. Even so, the long-term uptrend on Bitcoin dominance has arguably been broken, suggesting that it could still continue to fall. Just remember that this won't happen until there's a surge of new inflows. Recall that it's mostly the same money sloshing around right now. This means that we need to be much more selective about the cryptos we invest in, and constantly be on the lookout for where this currently limited capital could rotate to next. On that note, we couldn't help but notice that institutional investors seem hyper-focused on RWAs, some NFTs, gaming, and metaverse narratives. This is intriguing because the total market cap for NFTs plummeted nearly 50% throughout October, but has reportedly started to show signs of recovery. Tokenized real-world assets are set to close the gap between TradeFi and crypto by bringing stable, yield-bearing opportunities on-chain, allowing investors to utilize DeFi to earn returns on bonds, credit, and treasuries. And according to another report by DApp Radar, Web3 gaming and DeFi were the most active sectors in October. Looks like the smart money rally was in all the right places. Naturally, a lot of what happens next relies on market certainty. If Trump unexpectedly declares huge tariffs again, or if regulatory efforts like the Clarity Act run into any roadblocks, then crypto prices will probably suffer. Fingers crossed it doesn't come to that. For now though, following the smart money might not be the worst strategy. After all, we're just the dumb money, right? Anyway, that's quite enough from me. Now it's your turn. Do you feel re-energized, or is all of this nothing more than just data-driven hopium? Share your thoughts in the comments below. And if you want to learn why tokenized RWAs could be the future of finance, well, you should check that video out right over here. And if you want to see why the bearish sentiment could actually be bullish, well, check out that video right over here. That's going to be all from me today, so thank you so much for watching, and I'll see you in the next one. This is Lewis, signing off.